Should you invest your money or should you pay off your debt? This is a follow-up to a video about a year and a half ago, and the answer has definitely changed, so let's dive into it. Hi everybody, Quinn Waddington, Senior Investment Advisor and Portfolio Manager at Waddington Wealth, part of CG Wealth Management, here with a bit of a follow-up video to one I did about 18 months ago on whether you should pay off your debts or invest your money. Things have changed dramatically in the last 18 months. We all know that interest rates have gone up, but they've gone up in record fashion, and we're now dealing with a much higher interest rate world. So as much as a few of these things are really going to speak to everybody, this question definitely does come down to your personal situation, especially when we get to the end. But I'll point out a few things that likely is good advice for just about everyone. Firstly, if you have high interest rate debt, similar to the way it was before, something like credit card debt that's 18, 20, 22%, you should be paying that off. Markets can't be that on average. Yes, you're going to have years where the market outperforms those numbers, but on average, depending on what index and which country you're looking at, the markets are making 9, 10, 11% per year. Never going to compete with a 20% interest rate. So you should be paying off that credit card debt, and if you can help it, you shouldn't be adding to that debt. You should be looking to pay off that credit card debt every month. I know it's not possible for everybody and things come up, but if you have credit card debt right now that you can't pay off monthly, you should be really working towards a plan to get rid of that debt and get out from underneath that kind of rock, so to speak, which I know can be crushing at those high interest rates. On to the next level of debt. Some people line of credits that are variable are now in the 7, 8, 9, 10% range, especially if they're not tied to real estate. If you got personal debt that's 8, 10, 12%, you should also be looking to pay that off. This stuff, if it was variable rate, might have been a lot lower 18 months ago. But if you're in the 8 to 12% range or higher, you should be looking to pay off that debt as well. We are in the similar rate of return range to where the markets perform on average. But the markets have a lot of volatility with them, so you look at it at a risk-reward, on a risk-reward scale, you're much better off just paying that debt. That paying your 10% debt is basically a guaranteed 10% return, whereas the markets will average a 10% return, but of course you're going to get years higher and years lower. So adding that volatility in, to me, it makes more sense for people to be paying off that higher interest rate debt. The big question that everybody wants to have an answer to, and the one that really does need a deeper dive into your personal situation, is whether you should be paying off your mortgage or investing. We get this all the time. Our planners on the team are more than happy to walk through scenarios, figure out what that looks like, because it doesn't just come down to the numbers, although we do run those for you. That's the easiest way to do it. But there are a lot of other factors as well, including how risk averse you might be and how badly you really want to pay down your mortgage, because I know that's high priority for a lot of people. But we can help with those situations, run the scenarios, show you what that looks like and how do we optimize what that looks like. But going in with a couple examples here. So 2020, with the pandemic, obviously interest rates went dramatically down right at the start of that, with governments trying to pump up the economy. So those with locked-in rates from 2020 or 2021, in the 2%, some lower even, but 2 or 3% locked in. Even before the pandemic started, rates were below 3%. So anybody in that kind of 3% or lower range that's locked in might still have 2+ years left on a 5-year fixed, if that's what they did. Your opportunity right now with interest rates where they are, if you're able to save more money, even if you just put that into a high interest savings or a GIC until the end of the maturity on your current 2% mortgage rate, you're earning 5.5, or even higher potentially. percent on cash right now. So GICs with or high interest savings with very little risk attached to them, earning interest, you're going to earn say 5.5%, where you're only paying 2%. You're going to make 3.5% return over the next couple years. And then you could take all of the funds that you were going to add to your mortgage at the lower rates and throw them against your mortgage when it comes time to renew. You're going to be ahead of the game. Now, of course, that doesn't take into the consideration taxes. So depending on if that's in a non-registered account and what kind of GIC or high interest savings you're using, that might cut into the returns, but you're still going to be ahead of the game, putting your money aside rather than throwing it against a 2% mortgage. As mentioned, you can still have a plan to pay down that mortgage, but paying it down now when the rate is so low likely doesn't make sense from a financial perspective. Some others now, if you're in a variable rate mortgage, you might be up in the 5, 6, 7% range. We're getting closer to that area where it likely does make sense for you to start adding money to your mortgage. If you're at 7%, that's a guaranteed return of 7% if you can pay down your mortgage, versus putting it in the markets where you're going to average that 9, 10, 11%, but it's going to be a long-term plan to be investing, because you're going to have years like this year in 2023 where the markets are outperforming, but you're going to have years like 2022 where the markets underperform and your investments will drop. So if you are in a 5, 6, 7%, and of course as it gets higher, the risk of underperforming gets higher as well. But if you're in that kind of 6, 7% range, and you're willing to throw that money into investments for the next 10 plus years, then you're likely going to come out ahead if those funds aren't taxed. So we're looking at adding funds to a TFSA or RRSP, and then another idea being the RESP if you have kids where you get grant money. Then it might make sense for you to invest, but you have to know that those investments are going to be volatile. Like I said, if you're locked in and rates are really low, then we really dive into those situations and those individual details about your situation on how much TFSA room, RRSP room, RESP room, what's your income level, meaning, to help us guide on what your tax will be on investing any of those funds, where what your future kind of holds as far as income levels go, or other objectives you might have, purchasing houses, etc. Downsizing, upsizing, all of those things can come into the scenarios we run. And we figure that out again with our planners, putting all of these pieces in place, because it is a pretty detailed answer. So whereas paying off your credit card debt pretty much makes sense to everybody, whether you should pay off your mortgage or not really depends on your current situation, both from a financial perspective and from how emotionally you are in your decision making. Whether you want to increase your kind of safety measure by throwing money into the mortgage, that is much more defensive than investing in the markets, but doesn't lead to likely won't lead to as big a growth in your net worth over the long term. But it's not a one size fits all. And for a lot of our clients, what we will often find is that you can do both. You can, we might decide, yes, we want to top up that RESP because you get the 20% grant money, plus the growth is growing in there tax deferred, and likely will come out under the kid's name where you won't be taxed on it. So RESP might make a lot of sense. RRSP might make a lot of sense up to a certain level, again, depending on what your income levels are and what other contributions you might be making through employers or whatnot, and pensions, etc. But RSPs might make a lot of sense to reduce your tax level and maybe give you a tax benefit back later that you can then use to either use against RRSP or against your mortgage or put back into your investing accounts. And then TFSAs might make some sense if you want a bit of an emergency savings or you're saving up for something else it might make sense to add some funds into a TFSA. And then after that, look at if there's extra funds around, then maybe it makes sense to throw those against a mortgage, especially if it's in that 5, 6, 7% range, or adding it to a high interest savings, setting that aside so that you can pay down your mortgage when it matures. So all of these things are factors we consider. Again, very tough to know how to advise somebody without getting all the details. So if you want to chat this through, happy to have a free consultation meeting. Just book yourself in, use the link above, and happy to have a chat, kind of run through what we're looking at, get some more details from you. You can ask me a bunch of questions, and we can figure out if it makes sense and there's a good fit, whether we should take the next step and really begin a full discovery for you and your family to make sure that you're optimizing what you have, what you're going to have, and the situation that you're currently in. So again, any questions, let me know. Any comments, put them below. Feel free to pass this video along, share, like, subscribe, all those great things. Hoping to put out a bunch more videos like this going forward. So really look forward to hearing your feedback. Thanks, take care.